Welcome to my channel. I'm Scott, and if you want to catch my newest video, I post one every day. In this video, I'm going to walk you through the process of valuing General Dynamics stock by analyzing their financial statements and dissecting their financial ratios, so we can determine if it's a buy or a sell. General Dynamics is an aerospace and defense company. It's the 5th largest defense contractor in the US and 6th largest in the world. Its headquarters are in Reston, Virginia. The company was founded in 1899 and evolved through multiple mergers. Let's get started with the model. This is a large cap company, 44 billion market cap. They're trading at $154 a share, and they have 287 million shares outstanding. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount that number back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. The company has lots of free cash flow each year, $3.5 billion in 2017. It did drop to $2.5 billion in 2018, but it was $2.7 billion in the trailing 12 months, a tough year for a lot of companies. Net income is the profit and loss on the income statement. It's revenue minus expenses. And they have positive and pretty consistent net income each year, $2.9 billion to $3.2 billion. Revenue is the sales for the company, and that increases from $31 billion to $39 billion, then drops a little in the trailing 12 months to $38 billion. This is the income statement. The top line is the revenue, the sales. Below that is the cost of revenue. These are the expenses directly related to generating the revenue. And revenue minus cost of revenue gives you your gross profit. And that's down a little in the trailing 12 months. It peaked in 2019 at $7.1 billion. Below gross profit is operating expenses. And then gross profit minus operating expenses is your operating income. That was $4.2 billion, a little lower than 2019 at $4.6 billion, but still a good number. The company has a decent amount of debt, so they have about $500 million of interest payments on their debt. Then there's other income and expenses, which is pretty small. And then taxes. The bottom line of the income statement is the net income. That was $3.2 billion. That's pretty steady throughout the years. This is the company's statement of cash flows. The top line is operating cash flow. That's how much cash the company generated from its operational business. Then you have capital expenditures, which are investments in property, plant, and equipment. That peaked at $1 billion in the trailing 12 months. Operating cash flow minus CapEx gives you your free cash flow. That was $2.7 billion. In 2017, they had their highest operating cash flow and their lowest CapEx. The company issued over $8 billion of debt in 2018. This is probably to acquire another business. In the other years, they didn't really add much debt to their business, just in 2018. This company pays a dividend, but another way to reward shareholders is to buy back stock. They bought back $1.6 billion in 2017, $1.8 billion in 2018, $200 million in 2019, and $500 million in the trailing 12 months. Buying back stock is a really popular thing for companies. In order to appear attractive to investors, they want to see their stock increase, not decrease. So a way to do that is to buy back stock. It lessens the shares in the market, making the current shares more valuable. The most important part of any business is their operating cash flow, and this company has lots of operating cash flow, $3.7 billion in the trailing 12 months. To calculate operating cash flow, you start with net income. That was $3.2 billion. Then you have to add back the non-cash items on the income statement. They had $847 million of depreciation, $52 million of deferred taxes, $121 million of stock-based compensation, and $358 million of other non-cash items. You also have to adjust for changes in working capital, because if a company buys a lot of inventory one year, that detracts cash flow. So that's a negative on the operating cash flow section. But if this company was to sell a lot of inventory in an accounting period, that would be a cash inflow. In the trailing 12 months, they had negative $870 million in working capital. This is not just inventory. This could be changes in accounts payable, accounts receivable, any working capital category. So even though the company had $3.2 billion of net income, they actually generated $3.7 billion of cash flow. Net income is accounting profit and loss. It's not actual cash. To see how much cash the company made or lost, you have to look at the statement of cash flows. Let's look at a capital structure. They have $13.5 billion of equity and $13.5 billion of debt. So they're 50% equity, 50% debt. And their WACC is 8.6%, and that's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4, that's $62 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $56 billion. We divide that by 287 million shares. And we get a calculated stock price of $194. They're trading at $154, so they're trading at a 20% discount. It's a buy according to the model. Simply Wall Street is very close to me. They're at $187 a share, so they're also saying the stock is undervalued. It's a buy. It looks like the stock peaked about $220 in 2017 or 18. Then it's been dropping little by little, so it seems to be at a major discount relative to its all-time high. My valuation and Simply Wall Street's valuation is also below the company's all-time high, so I definitely think this stock has a lot of room to grow. The company raises its dividend each year. They pay a 2.8% dividend yield, and their payout ratio is 39%, and they pay out 46% of their free cash flow. That's dividend payment over free cash flow. The 52-week high was 190 and the low was 101. The stock is trading above its 50-day and 200-day moving average, so it seems to be an uptrend. And the stock has a fairly low trading volume. Only 1.5 million shares are traded each day. If you invested $10,000 into this company 10 years ago and reinvested the dividends, you'd have about $26,600 today. If you did not reinvest the dividends, you'd have $25,100 today. So if you invested $10,000 in January 2011, after a few months, your $10,000 would have been down to about $9,000 or $8,000, but then it would have came back up and you would have been in the green ever since. If you sold at the peak, you could have sold at about $36,000, but if you're still holding on, you still have a decent return on investment. The average annual return in the past 10 years is over 10%. The biggest shareholder is Longview Asset Management at 11%, then Vanguard at 7%. Also, the company has a 401k plan that owns 7% of the company's stock. James Crown has an investment firm. He's also a director of the company. He owns 5.4% of the stock. And then Wellington, 5.3%. Let's look at their financial ratios. The average PE in the market's 11.7. The median is 14.8. PE is stock price over earnings per share. To calculate earnings per share, that's net income over shares outstanding. They're at 13.9, so that means investors are paying $13.90 for $1 of earnings. That's between the median and average. Price to sales is stock price over sales per share. They have a really good price sales ratio at 1.2, much better than the median and average. Price to book is stock price over book value per share. They're at 3.3. That's between the median and average. And the way you calculate book value per share, it's equity over shares outstanding. Equity is assets minus liabilities in the balance sheet, and they have $14 billion of equity, but negative $8.4 billion of tangible equity because they have $22 billion of intangible assets on their balance sheet. Interest coverage ratios, EBIT over interest expense, they're at 8.8, so they can easily cover their interest payments. ROE is net income over equity. They have a great ROE at 23%, much better than the median average. Current ratio is current assets over current liabilities. They're at 1.2, so they can cover their current liabilities with their current assets. And their current assets are mainly receivables of $11 billion and inventory of $6 billion. So the company does seem to be well capitalized. They had $2.7 billion of free cash flow, $3 billion of working capital. Working capital is current assets minus current liabilities. And they had a $1.2 billion dividend payment. The best way to look at ratios to compare them to similar companies, I've done videos on Boeing, BWX, CAE, Airbus, Fireon Technology, Huntington, L3Harris, Lockheed Martin, Magellan, Ruger, Rolls-Royce, Raytheon, Spirit Aerosystems, TransDigm, and Textron, all in the same industry as GD. And if GD has a number in green, they're better than the average. If they have a number in red, they're worse than the average. GD has really good ratios. They're pretty much better in everything. They're better in PE, much better in price to sales, much better in price to book. They do have a lower current ratio, but 1.2 is fine. ROE, they're a little better than average. They're also a little better in debt than average. They're a little bigger than the average in market cap. And they pay a really good dividend, 2.8%, much higher than average. So to summarize, I have them trading at a 20% discount. This company's still going strong, generating lots of free cash flow, even during coronavirus. And this is a really big company. It's been around a really long time, so it's not going anywhere. A great long-term investment. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.